VCTs, or venture capital trusts, are just that, an investment fund quoted on the London Stock Exchange where you entrust your capital into higher risk ventures. If you're not a high earner looking for a higher risk investment with attractive tax reliefs, may I politely suggest you change the channel now. If you're still watching, we'll assume you are a high earner interested to know how a VCT could play an interesting part in your overall tax and investment planning strategy. In this short video, we'll look at the potential upsides and the downsides, as well as the practicalities of investing in a VCT. So why did the government introduce VCTs back in 1995? Well, to encourage wealthy high earners to invest indirectly into smaller UK early stage growth businesses in return for 3 generous tax reliefs for you, the investor. Number 1, income tax relief. You receive a 30% income tax rebate on your investment in a VCT. So invest £100,000 and your next tax bill reduces by £30,000, assuming you've paid that amount in income tax to start with. The maximum you can invest in a VCT is £200,000 each year, and for you to qualify for the income tax relief, you've got to hold your VCT for 5 years. If you sell it within the 5 years, you must pay back to HMRC the tax relief that you've had. Number 2, after 5 years, your VCT is free from capital gains tax on the profit that it has made. And number 3, tax-free dividends. Assuming the investments are doing well enough, many VCT managers pay around a 5% dividend, which in a VCT is tax-free. So in the hands of a 45% taxpayer, that's equivalent to an 8% gross return. And why many investors in VCTs keep them far beyond the 5-year minimum holding period, because where else can you get a tax-free income of 5% a year? So how do you invest in a VCT? Well, through an investment trust listed on the London Stock Exchange, with all the transparency and governance that comes with that. You pool your money with other high earners' cash, and the fund manager then chooses typically around 20 to 50 UK growth companies to invest in. That's following significant analysis and due diligence that the VCT manager has carried out on hundreds of possible UK growth company opportunities. And that's why you're paying the VCT fund manager for their expertise in the world of venture capital. And their fees aren't cheap, they're typically around 2.5% a year. In the past, VCT managers have invested in small companies that have become household names like Zoopla, Graze, Netflix, Uber, and many others. What have the average VCT returns been like? Well, the better VCT managers have delivered average annual returns of around 7% a year for their investors. But what are the downsides, or what's the worst thing that can happen when you invest in a VCT? VCT funds will invest in companies that fail. That's the nature of the beast. It's unlikely, but you could lose all your money if every company the VCT manager backed goes on to fail. But that's why VCT managers have a portfolio of typically between 20 and 50 UK growth companies to diversify your risk. However, you still need to think of a VCT as a high-risk investment and only allocate a percentage of your capital that you feel really comfortable with. But VCTs are not a replacement ISA or pension. We believe you should only consider investing in a VCT after you and your family have maximised your pension and then ISA annual allowances. Finally, VCTs are not easy to sell. The demand for buying existing VCTs in the secondary market is nowhere near the demand for investing in new VCTs each tax year. So you could struggle to find a buyer for your units quickly and often receive a discounted price to the quoted value. This could typically be around 5 to 10%. If you'd like to talk to one of our chartered wealth managers about whether investing in a VCT is suitable for you, then please click on the link below and either send us a secure message or book in a video call at a time to suit your diary. We look forward to helping you, and thank you very much for watching.